the psychology behind investing. When people lose money, they feel 5 times greater pain than the euphoria they feel when they're making money.
And it's heightened around the investment decision-making process in an election year.
Welcome to It's All About Clarity, the go-to podcast for bringing clarity to your financial journey. Join Mark Pearson and the Nepsis team as they share insights to portfolio management, tax strategy, and more. Whether you're interested in investing, retiring, giving, saving, advising, or tax planning, here it's all about clarity.
Welcome to It's All About Clarity podcast. I'm super excited today to have my good friend and longtime Investing with Clarity podcast comrade, Chuck Etzweiler. Chuck.
Great to be here, Mark. I like that introduction.
This is our first podcast together since we launched It's All About Clarity
Absolutely.
podcast. Of course, for those who have been following us for a while, we used to do the Investing with Clarity podcast, and now everyone gets to see your pretty face and big smile.
Well, thank you. It's great to be here.
That's
I really appreciate you having me.
Excellent.
You got it.
So let's get right to it, Chuck. What are we talking about today?
Well, tis the season, right? It's an election year.
Oh, Lord,
a
help us
presidential election year.
If I start getting political, just cut me off, would you please?
Well, we always pride ourselves on being apolitical.
Yes, well said.
But it still doesn't dismiss the fact that there are people out there that are political.
Yes.
And they do the most toxic thing. We talk about this all the time. They intertwine emotions with investment decision-making. And that's not clarity, right?
That is not clarity. And, of course, as you and I have talked about many times before, the emotional predisposition people have when it comes to investing, right? The studies, correct me if I'm wrong, the studies have been done, the psychology behind investing. When people lose money, they feel 5 times greater pain than the euphoria they feel when they're making money. Is that fair?
It's exactly correct.
Yeah.
And it's heightened around the investment decision-making process in an election year.
Yes.
So I'll give you one, and we'll start off with this. How's that? And I'll walk you through it.
I'm here to learn.
I appreciate that.
Thank you.
So CBS News, our friends at CBS News,
You're
started this poll. Yes. They do a simple poll.
Okay.
All the way back to 1990. So if, I've caught myself saying this numerous times. I'm getting so old that I remember when.
Yes.
So I remember George Herbert Walker Bush, or Bush 1.
Yes.
So he's elected in 1988. He takes over for Ronald Reagan. And
yes.
He's president. And we go into...
By the way, can you believe how many people we have work in our firm who were not born in 1990?
I know. That's incredible.
It's great, by the way.
I was cutting my teeth in the business at that point in time.
Yeah. Well.
But we did go into a recession.
We did.
And here's what CBS News would simply do. They would get a reporter. The reporter would walk down the street and randomly ask a person 2 questions. Ma'am or sir, what's your political affiliation, Republican or Democrat? Then here was the kicker. Do you think the economy's good or bad? And they would take that poll and they would extrapolate thousands of answers.
Interesting.
It really is interesting. And here's what they found, Mark, that for George Herbert Walker Bush, Bush 1, and Bill Clinton, it didn't really matter if you were Republican or Democrat at that time. You gave a truthful answer as to how the economy was.
Right.
So they tracked one another. And, unfortunately for George Bush, he served 1 term, and the economy really wasn't good towards the end. We had the recession.
Right.
So Clinton takes over. He's got a couple of battles in 94, 98, and the polls look bad from a Republican and Democratic standpoint. But here's the thing. When George W. Bush takes over, there's this massive divergence in the answer from a Republican or Democrat, irrespective of how the economy was, as to their opinion of the person's, which is called duties in office. Mm-hmm. And that held through Obama, it held through Trump, and it holds through to Biden.
Interesting.
So here's the point. So if you're a Republican, it doesn't matter whether the economy's doing well or not. Your person's in office, you think it's good. If you're a Democrat, it's vice versa.
Right.
That's how divisive things have gotten.
Yeah.
And people using emotion, so they'll just be dismissive. My person's not in the office, so the economy must be bad. I won't invest.
Yep.
And that's what actually the outcome
Yeah,
is.
it's interesting, and of course, when you get into election year all the time, these news shows will put up the statistics. If they're Republican tinted, they put up Trump's statistics and they look great compared to Biden's statistics that don't look great. And while the numbers in some cases may be accurate, the reality is no numbers, good or bad, tell the whole story.
They don't.
And I think what's important for investors to remember, obviously from our perspective, it's all about clarity. We started at investing with clarity, know what you own and why you own it. And I think what's super interesting is, the reality is that great businesses will adjust. It doesn't matter what the policies are of a particular president. The reality is that great businesses who have great products and great services will adjust. And if a company's stock goes through a period where it's down, we love that. I mean, we always tell our clients, right? Expect a 20 to 30% correction. Always expect it, because you know it's going to happen again. And how many times have we gone down 30% in the last 10 years?
We probably, you caught me on that one. I'm going to guess 4
I was thinking it was 3.
Yeah, it was 2 in 2022. That's the two.
2022,
Right.
2019.
Correct. And
right?
of course,
Or 2020.
2020, which was COVID.
Yeah.
We didn't hit 30 last year, but we've had 4 20% drops
Yeah.
since the COVID crash of 2020. Yeah.
4
4.
since 2020, an average of once a year, right?
Great point.
Yeah. So always be prepared for a 20% correction, a pullback, because you have the ability to buy a great business on sale, right?
No doubt about it, and it leads to this second issue that people make. So the first one is they conflate their political affiliation with how the economy's doing good or bad. That's the first one. The second one, and you nailed it, is in an election year. So we're in an election year. You historically have 2 trends how the market works. And the market's this basket of stocks, which we don't care about, but we cited it nonetheless. If you have an open election, so an open election would be like 2000, when you had George W. Bush going up against Al Gore. Neither had served in the office of president before. You had 2008 with Obama and McCain, and then certainly 2016 with Trump and Clinton. You have this unknown because we don't know the policies, and you're right, you get this pullback in the middle of the year, and what do people do? They distance themselves from their investing, they pull money out, but what does clarity say? What have you done in those instances? And that's what I love.
Yeah.
Great opportunity, to buy businesses on sale.
Yeah, you know what's funny? I used to tell this story after the financial crisis in 2008. And of course, that financial crisis brought the markets down. The S&P was down top to bottom. I think it was 50%?
It was 54%.
54% from top to bottom. And clients and financial advisors, this is when we were doing more third-party money management, financial advisors in particular, and remember, these are people responsible for people's money, right? And they'd all say to me, how did you fare in 2008? How'd you do in 2008? I always said, we did phenomenal, because we did incredible in 08.
And they always
go, well, how much were you down? And I said, I don't know, we were down with the S&P. Oh, how was that great? And I would always say this, you're asking me the wrong question. What do you mean I'm asking the wrong question? No, I'm not. I want to know how you did in 2008. The reality is, the right question to ask is, how did you do in 2007, and how did you do in 2009? 2008, as I said to our clients, and I'll say it again, just like it was in COVID, this is the greatest opportunity we have had to buy business on sale in a generation, and maybe even in our lifetime. When you get a 50+% pullback, that is the opportunity to look at your portfolio of businesses you own and decide, okay, when this is done, what do I want to own coming out of this. I can tell you, I'm going to go by memory here. I remember buying MasterCard. At the time, it had gone from 400 to 200. Today, it's trading at 380, 390. By the way, that's with a 10-for-1 split.
Exactly.
Actually, I think it's done a 10-for-1 and a 2-for-1.
Yeah, it's had two splits.
It's incredible. And that's what people don't look at. They are short-sighted. They're emotional, as you said. So in this particular year, politics aside, what is some of the chatter you're hearing from newscasters, from so-called experts that are out there?
Excellent question. So the first one was the possible inability of either of these candidates to actually make it through the primaries. Health reasons, legal issues, whatever it may be.
Yep.
And that's caused investors to pause. But here is what I love what you were just saying. It's also what you and Brian were talking about. You heard the old Ben Franklin quote, there's only two things you can depend on in life. It's death and taxes.
Yes.
When we walk through an election year, there is something we can be certain of. There's going to be a result.
Yes,
and there's going to be
right.
somebody sitting in the office, right?
Right.
So,
and the businesses are going to continue to make money.
Exactly. And they can leverage some of the policies that some of these folks have to their betterment. And we all know that they have high-powered individuals working on their staff to figure that out.
Right.
So the point is, every 4 years, it's almost like there's this pullback that happens that is opportunistic that you can bank on, unlike a black swan event, which comes out of nowhere.
Yes.
We look at it, but investors don't look at it that way. They should be looking at this uncertain period right now through the primaries as a gift.
Absolutely.
Because what are we doing? We're searching for businesses on sale that we know once we get through this mini storm, will not only survive but thrive.
Business as usual after.
Absolutely.
Yeah, you made a great point. You said when someone comes into office, they're going to have their high-power staff, smart people to figure out where's the best place to invest and how to make money. That gets to the power of knowing what you own and why you own it. That gets to the power of investing with clarity, because when you know what businesses you own, that gives you greater clarity in the decision-making process on the policies that the government brings in. So we may make some portfolio minor adjustments, but our holdings are generally public because we have to file with the SEC quarterly, our positions. But ultimately, we don't make a lot of changes because the businesses, most of the businesses we own, do well no matter who's in the office of the presidency.
And that's the way that it should be.
And that's the way it should be. And so, you talked about a black swan event, another aspect, I think, of the power of knowing what you own and why you own it. And I've used this story probably before when we used to do our Investment Clarity podcast. But I remember I was sitting on my cross trainer working out one morning, and the news came on and said that a tsunami hit Japan.
The Fukushima, the earthquake, right?
And the tsunami had wiped out so much. So many people died and so much was destroyed. And when the stock market opened, I remember one company in particular, because we still own it, was called Renaissance Re. And Renaissance Re is a reinsurance company based out of Bermuda. And the stock was down like 19% when the market opened, because everybody sold off insurance stocks because they were afraid of all of the expense that they were going to have to pay out in the event of that tsunami. Yes. Well, the reality was that I knew literally when this thing opened up, and by the way, stock went from like 77 or 79, somewhere in there, went down, opened at like 62. And right there, we bought Renaissance Re as much as we needed for our portfolios. Today, that stock's at $230 a share.
Amazing.
The problem was Renaissance Re had nothing to do with any insurance in Japan or any of the surrounding areas that were affected by the tsunami, right? So know what you own and why you own it. And the point of that is also with the election, we don't know who's going to win the election, and everyone can prognosticate, postulate, and speculate, but take advantage of the emotional predisposition of investors who don't have clarity in their portfolio and take that opportunity to buy great businesses on sale. Right now, while we're doing this podcast, we've seen about a 5% pullback.
Yeah, it's about what peak to trough. Yeah.
Yeah, it's a 5% pullback. And how long has it been since we've seen a 5% pullback even?
Yeah, it would be October of last year of 2023.
Yeah.
We had a great run, and it's interesting, the longer the bull run goes, whenever there's a pullback, people start to just panic, and it's amazing. It's like 5% is a blip. The average pullback is 14%, right?
On an annual basis. Yeah, explain that again, please, for people who don't know this.
Yep.
So peak to trough each year annually on average.
Yeah, it's an amazing statistic, and you could take it all the way back to 1945. Most happened to 1980. From the point of the peak to the bottom in an annual given year, the average we'll call drawdown is 14%. And you would always say to all the advisors, always tell your clients to expect a 15 to 20% pullback.
Right.
And you're not just saying that for the sake of it; it's truthful.
Yeah.
You want to underpromise and overdeliver. So it's just say we could get a 20% pullback at any time, but what are we going to be doing?
And if it's 30%, while it can go down to 50, the reality is from 30 to 50 is only a 20% pullback, darn near the average each year. So when it's down 30%, I'm backing up the truck.
Sure.
And we're buying the top names, right? We have our conviction index we use, we've talked about before in the Investing with Clarity podcast. That conviction level at 30% down, because a lot of stocks at 30% down on the market, so to speak, a lot of stocks are down 40, 50%.
They are. Absolutely.
You're backing up that truck all day long. Okay, the election. Any other great, I love having you on because you got all the great stats and the great stories.
I do have one more for you. How's that?
Beautiful.
So Bespoke, which is one of the independent research firms
Yes.
that we subscribe, our listeners and our watchers may know Paul Hickey's on CNBC quite a bit.
Yep.
So there's a database that they have. So we thought to ourselves, let's go all the way back to the turn of the 19th to the 20th century. The Dow Jones Industrial was created in 1896. So you start in 1901.
Yep.
And you just plug in who the president is at that time. You ask whether they were Republican or Democrat, but you start at the day of inauguration. And the reason you do that is because they now have the power to enact legislation or
Change
promote,
policy.
exactly, executive privilege. They have the pen, the phone. You start with Theodore Roosevelt in 1901, you work yourself all the way up to Joe Biden, and you bifurcate the two parties. The average rate of return, this is not total return, it's appreciation, is 7.7%. You add a dividend to that, and that's how you get your 10.5 for equities. If you look at Republicans, it's 7.9, Democrats at 7.7. And you tell people that there's no difference when you stretch it out.
Right.
Yet they're still not convinced of that.
Right. And they sell stocks, and a lot of times they end up paying taxes in their non-IRAs for selling positions just because they're nervous. They end up having a short-term or a long-term capital gain, right?
The mistakes that are made just because of that toxic mix of emotion, again, is amazing. And I'll end with this on that point, and you brought it up, is that there are policy issues that maybe affect sectors or industries. That's undeniable. And that's part of the clarity understanding of a business, is to know which side of the aisle is going to favor that business. We look into that. But the president, although they have much effect on a lot of things, right? I mean, the commander-in-chief and the executive branch maybe has too much power, but nonetheless, there's no power over the price of businesses over the long term determined by who the party is in office.
Right. Because companies will adjust.
Exactly.
Right? They'll either lay off or they'll hire people. They'll reduce a dividend, add a dividend, they'll do whatever. I think one of the interesting things, this is going to put you on the spot potentially. One of the things I think is interesting, that when we love oil stocks. We bought a lot of oil when it went negative, which is mind-blowing in and of itself, but during COVID. But I would talk to people about going into oil wells. I would talk about investing in the oil companies. And for a couple of years in the recent past, Devon Energy was one of our largest holdings.
Certainly.
And people would say, there's no way I'd buy oil. In 2020, when it was at negative. Oh, you got a Democrat in the office. Democrats hate oil, and oil is going to be super poor to invest in. In 2020, what did oil close that year at? Do you remember?
It was down in April of 2020. It was down to negative 43 for 2 days, and it closed in the 50s. It went all the way. It had a $90 increase.
And that was because of all the arbitraging that was going on, and all the hedging in the market that was going on and was being manipulated by a couple of ETFs out there, right?
Absolutely.
Know what you own, why you own, because oil really, no one really sold oil at a negative $45 a barrel. Well, now today, with Biden still in the presidency, oil's at close to $90 a barrel, right? And it did get down to 70 after it hit 90. It hit 100, actually, I think. Went back
during
all
the
way
Ukraine
down,
war. It was up to 130.
Yeah, 130. Comes all the way back down to 70. Now it's back to 90. But I know this, whether it's 70, 80, 90, or 100, it's all been during Biden's presidency, and it's all a lot higher than it was when Biden got into office. Oh, by the way, Democrats may not like oil, but the reality is the markets dictate what someone's willing to pay for something, not the president of the United States.
It is such a classic example why what the Biden administration did, good, bad, or indifferent, no matter what your politics are, they reduced the supply.
Yes.
And as you said, the demand was still there.
Yes.
Low supply, higher demand, price goes up. It's that simple.
Welcome to capitalism.
Exactly. In Devon, we looked at this free cash flows at $45 a barrel.
Yeah.
I mean, that's ka-ching. Anything 65 or above.
Yes. Most oil companies in the United States are quite profitable with oil above 30.
Yeah, absolutely they are. Yeah, because of the technology through fracking.
Yes.
So great
so the stock
example
may
on
get
that.
volatile, right?
Yeah.
But if it's volatile, if it gets down like that, what do? You go buy more.
Absolutely you
do. Go buy more because it's not going to go away. Great. You always have great stats. Can't wait to have you back. Any closing stats? You always have good tidbits for our listeners and watchers. You got anything else for us?
Well, I think the three ones that we went over were really compelling about election. So for those who maybe don't work with us, just think about walking through this primary season and think about the last thing that somebody wants to do is to sell their stocks, pay gains, and go to cash. It just is foolish.
And try to guess when the bottom's going to hit in.
Because nobody can do that.
Yeah.
And partner yourself with somebody who understands businesses deeply so, and own those over the long term using a policy that we call strategic cost averaging.
Yes.
That's the way to create and preserve wealth over time.
You got it. I can't wait to have you back, Chuck.
Well, thank you, Mark.
This is Chuck Etzweiler, my head of research here at Nepsis. Chuck's been with me for 20 years, but probably a little bit more. Yeah.
21 years.
You haven't aged a bit.
Yeah, well, thank you.
All right. Well, thanks for being with me. We'll look forward to having you back soon, Chuck.
Thanks, Mark. Appreciate it.